Welcome back to the Neuro Finance Masterclass. We are on day 84 of the 365 Days to Financial Freedom series, and wow, we are so pumped for today's explainer. What we're unpacking today is literally the definitive line in the sand. It's the difference between staying stuck forever and actually building true generational wealth. Today is all about the power of leverage. We're diving deep into the ultimate showdown, good debt versus bad debt. We're basically going to completely rewire your brain on how you view borrowing money. For most people, debt is a dirty word. It's terrifying. But by the end of this, you're going to see it as the absolute most powerful tool in your financial toolkit if and only if you have the discipline to wield it.
So, let's look at this massive number right out of the gate, 99%. That is the percentage of the population operating under a massive limiting myth. Almost everyone was raised with one simple, terrifying lesson, right? Stay out of debt. All debt is dangerous. And honestly, for that 99%, it's actually fantastic advice. Why? Because they only know how to use debt the wrong way. They use it emotionally, impulsively, destructively. But to reach the absolute pinnacle of financial independence, we have to break away from the herd. We have to start thinking like an architect.
And the architect's perspective is completely profound. They understand that debt is exactly like fire. Think about it. If you're careless, if you don't respect it, and if you have absolutely no idea how to contain it, it will burn your house down. It will destroy everything you've ever built. But, and here is the major aha moment, if you master it, if you actually understand the physics of it, that same fire can power a steam engine, it can heat an entire city, or power an empire. Debt is totally neutral. It's the intent and the math behind it that dictates whether it's a weapon of self-destruction or a tool of immense creation.
All right, let's get into section 1, bad debt, the anchor.
This is the highly destructive type of debt. You have to aggressively, relentlessly avoid or eliminate this at all costs. So, what exactly is bad debt in the real world? Very simply, bad debt is borrowing money to buy liabilities. And a liability is anything that instantly goes down in value the second you buy it, or something that continuously bleeds your wallet dry every single month. We're talking about taking out a high-interest loan on a luxury car just to look rich. We're talking about swiping a credit card with a crazy 20% interest rate for designer clothes. Or financing the newest $1,000 smartphone when the one in your pocket works perfectly fine. Guys, these are not investments. They are giant financial sinkholes.
What's really fascinating here is the psychological toll. Bad debt is literal theft. You are actively stealing from your future self just to pay for a temporary illusion of status today. And physically, this debt acts as a massive, heavy anchor chained right to your ankle. It drains your monthly cash flow, and worse, it completely wrecks your neurofitness, your ability to stay calm and strategic, because you're constantly sweating about making next month's payments. Like we covered back on day 83, bad debt traps you at level 1 of the wealth ladder. There is simply no way to climb up if you are actively pulling yourself down.
Moving on to section 2, good debt, the rocket fuel.
So if bad debt buys liabilities and sinks your cash flow, good debt is the exact opposite. Good debt is when you borrow money specifically to acquire assets, things that actually put cash into your pocket every single month or predictably grow in value over time. This is a totally different species of debt. You aren't borrowing to consume, you are borrowing to produce. You are strategically using debt as rocket fuel to launch your net worth into the stratosphere.
Let's break down the pure, beautiful mathematics of how this rocket fuel actually works. Imagine you go to a bank and borrow money at a 5% interest rate. You take those funds and you buy an investment property, a solid business, or some reliable asset class that generates a 12% return. The absolute magic here is that 7% gap right in the middle. You pay the bank their 5%, but your asset is paying you 12%. That 7% profit, that belongs entirely to you. You are building wealth using OPM, other people's money. You didn't even have to use your own capital to generate that yield. That right there is the absolute genius of good debt.
Which brings us to section 3, Archimedes and Calderach, the concept of leverage. We are taking a fundamental law of ancient physics and plugging it directly into your path to financial freedom. Leverage is simply the strategic use of good debt to multiply your asset base. Look, if you only ever use the cash sitting in your own pocket, your ability to buy assets is totally bottlenecked by how fast you can save up. But with leverage, you can control massive, high-value assets using just a small fraction of your own money for the down payment. The debt acts as a giant multiplier. It can literally accelerate your timeline to financial freedom by decades because you are doing so much more with so much less.
I absolutely love this quote. The ancient Greek mathematician Archimedes famously said, "Give me a lever long enough, and I shall move the world."
In physics, a really long lever lets one single person lift a massive, impossibly heavy boulder. Well, in finance, good debt is that long lever. It empowers an everyday, normal investor to control millions of dollars in real estate or business assets. It truly is the ultimate tool for moving your financial world.
Now, for Section 4, the rules of the leverage game. Extreme discipline required.
Okay, time for a massive reality check. Playing the leverage game requires extreme, unshakable discipline. This is not for the emotionally fragile, and it's certainly not for the uneducated. Over-leveraging has bankrupted billionaires. It has wiped entire massive corporations off the map. Using leverage safely requires peak neurofitness. You can't panic. You have to be completely, coldly analytical. Because of this, the architect always operates under 3 strict, non-negotiable golden rules. Rule 1, absolutely no short-term crypto speculation. Rule 2, the interest rate must be definitively lower than your expected return. And Rule 3, you must maintain sufficient dry powder. Let's be clear, if you break even one of these rules, you aren't investing anymore. You're gambling, and leverage will punish gamblers without mercy. Let's break these down.
Rule number 1. Never, under any circumstances, use leverage to speculate on highly volatile, short-term crypto assets. High-leverage futures trading? That is absolutely not for amateurs, and we do not do it in this masterclass. Why? Because leverage amplifies your losses just as aggressively as it amplifies your gains. If you're highly leveraged in a market that can easily swing 20% in a single hour, just one tiny dip will trigger a margin call and liquidate your entire portfolio in the blink of an eye. Leverage is meant for stable, predictable, cash-flowing assets. It is not for chasing chaotic, overnight crypto spikes. Rule 2 is your fundamental math check. The cost of your debt, meaning the exact interest rate the lender is charging you, must be significantly lower than the conservative expected return of the asset you're buying. I really want to emphasize that word conservative. Do not sit there and project some fantasy best-case scenario. If the bank charges you 7% and your conservative, worst-case projection for the asset is a 6% return, you walk away. Do not take the deal. You'd be generating negative cash flow. The math has to work in your sleep, even on a bad day.
And Rule 3, which is arguably the most critical for your long-term survival, always keep enough dry powder. We talked a lot about dry powder back on day 42. It simply means having robust, highly liquid cash reserves on hand at all times. Look, assets don't always perform perfectly every single month. Sometimes, just like we covered in day 72, the market enters a temporary winter. Maybe a rental property sits vacant for a bit. Maybe a business has a slow quarter. Guess what? You still have to pay that debt. Your dry powder is the cash reserve that covers your debt payments during the winter, making absolutely sure you never lose the asset while you're just waiting for spring to arrive.
All right, Section 5. The Architect's Audit, your cognitive task today.
This is the culmination of today's explainer. This is exactly where theory becomes practice. We are challenging you, right here, right now, to look in the mirror and audit your personal liabilities. You need to be brutally honest with yourself. Ask yourself, do you currently have any bad debt? Are you paying crazy interest on a depreciating car? Are you carrying a balance month to month on consumer credit cards?
If your answer is yes, then you have one singular, laser-focused mission. Your absolute, uncompromising priority starting today is to aggressively destroy that bad debt using your cash flow. Stop buying new things, cut the fat, attack the anchor. You simply cannot build a towering skyscraper on a foundation of quicksand. You have to clear the runway before you can take flight. Now, if you're listening to this and you already have zero bad debt, huge congratulations. You are in a rare elite percentage of the population, and your runway is totally clear.
For those of you with that clear runway, it's time to start thinking like a master builder. It's time to ask yourself how you can eventually use smart, low-interest leverage to safely multiply your assets. Stop being afraid of debt. Start mastering its mathematics. Because when you finally understand how to use other people's money to securely buy assets that pay you while you sleep, the entire trajectory of your life changes forever. So we're going to leave you with this final, provocative thought to carry with you today. Are you currently working for your debt, or is your debt finally working for you?